and a warm welcome to the Open Treasury podcast, your go-to source for the latest news and analysis in corporate cash and treasury management. This show is brought to you by ctmfile.com and the Treasury News Network, where treasury professionals learn and share the information that matters most. I am your host Pushpendra Mehta. Joining me today is Paul Galloway, Senior Director, Advisory Services at Strategic Treasurer. Welcome back, Paul, to another episode of the Open Treasury podcast.
Thanks, Push. Good to be back.
We truly appreciate your time and insights as we explore crucial topics shaping the landscape of corporate cash and treasury management. In today's edition, we shall discuss four topics, namely adapting and future-proofing cash segmentation for treasurers amid shifting interest rates. Global debt has hit a record US $315 trillion, reports the IIF. Swift and banks in AI pilots to tackle cross-border payments fraud. And finally, digital wallets in the US get a business bump. Our audience can watch videos on the CTM File YouTube channel and explore insightful articles, interviews, and industry roundups on ctmfile.com, either by visiting the website or by following the links provided in our show notes. Let's begin today's discussion with our first story, which is about adapting and future-proofing cash segmentation for treasurers amid shifting interest rates. At a time when cash and liquidity management are paramount concerns for corporate treasury, the significance of effective cash management as a vital tool for treasurers in managing cash across different environments cannot be overstated. At the heart of cash segmentation is the classification of cash according to the likely future needs of the business. This is done by using a cash forecast to categorize cash into virtual buckets, with each bucket representing a different time horizon and tolerance for risk. Each bucket can then be invested in instruments that reflect that tolerance as per the Association for Finance Professionals, or AFP's Executive Guide, The Future of Corporate Investing, that's been underwritten by Old Spring. Typically, organizations categorize or divide cash balances into three buckets or segments: operating cash, working capital, and strategic cash. This practice is integral to effective investment management, contributing to improved returns on the overall cash portfolio. In light of shifting interest rates, managing and investing corporate cash is a challenge for treasurers, yet even with the strong focus on the future movement of interest rates, the foremost objectives of investing corporate cash are protecting principal value and maintaining sufficient liquidity, while also identifying opportunities to generate yield without altering the segmentation process or investment policy, according to the AFP Executive Guide. To achieve this, the AFP Guide recommends certain cash segmentation changes and grasping SEC's latest round of money market fund reforms to seize yield-enhancing opportunities. Paul, for the benefit of our audience, can you summarize the key cash segmentation changes and the money market fund reform measures that are likely to impact corporate treasury?
Yeah, Push, there's a lot to unpack in this article, a lot of good information and material. So I'll try to go through this as swiftly as I can, but I do want to make some very succinct points tied to what was written in this article. So when you think about how treasurers look or view at managing cash, it shifts over time, and we can think about three buckets, which this article does a nice job of pointing out. So there's operating cash that's utilized for day-to-day activities, your working capital, current assets, current liabilities, how quickly do you get revenue in the door, what's the timing of meeting the requirements for payables, what's that net look like, and do you have leftover for medium-term uses within the organization, something that's a little longer duration than the daily operations. And of course, the strategic cash. And this is where organizations are investing cash, maybe in new products, existing business lines, or perhaps diversifying and acquiring new modes of revenue for the organization. So you have those three kind of buckets to manage. So when you think about overall portfolio management, you need to have in place some set of guidelines. So treasurers will often have investment guidelines that are tied to these various buckets and the limitations or restrictions of how they invest. It will be allocation across different asset classes, different types of risks associated with those asset classes. There may be regulatory considerations. And so I'll go ahead and kind of just hit on some of these. Some of these will be maturities. When you think about maturities with your book of assets and those three buckets I mentioned, you take into consideration in forecasting not just those particular buckets that may be daily activity for the company, cash coming in, current assets, current liabilities, and of course how you're going to allocate for strategic plays. In that forecasting, you want to be able to understand how you can match the duration of your portfolio or the maturity profile to the needs of the organization. Now, it doesn't mean that you go and tie it directly one for one. You may have rational reasons why you may be shorter dated in your portfolio. So you maybe have a ladder of maturities that you're rolling as things are maturing. It depends on what's going on with the yield curve. I'll get to the yield curve here in a little bit. Or perhaps you have a barbell strategy where you know for sure, hey, I've got something big that's coming up on this particular day and it's not changing. I'm going to invest to meet the match of the duration for that particular payment. So you might be matching, but you might be also changing depending on what's going on in the market. So being able to change allows treasurers to get better yield or return on their cash over a period of time. So you can't sit there and think about this is stagnant. I said it and I forget about it. That's not really what you should be doing. So the other piece that treasurers have to take into consideration is a duration of those investments. And so what I mean by duration is that instruments that you invest in, I'll talk about fixed instruments or bonds as a way to drive this message forward. And duration is really tied to fixed income instruments. And so we think about the maturity profile of the particular investment that you make. There are certain sensitivities that occur associated with movement in interest rates. And there's a inverse relationship with price of a bond and interest rates as they move. The yield of a bond may be fixed, it may be floating, but let's say it's fixed instrument. And so you have a particular rate or coupon that's being paid on that bond. The yield is determined based on underlying asset itself, the time to maturity, and the interest rate struck at the time that the bond was sold in the market. Interest rates change daily. And as interest rates change, they have an impact on the value of the bond. Interest rates go up, value of the bond goes down. Interest rates go down, value of the bond goes up. So it's an inverse relationship. And when you have longer duration assets, so something that's 10, 15, 20, 30 plus years, there's a lot more volatility associated with the movement in interest rates. So the price of the bond will fluctuate more. Another thing for treasurers to consider are investments where there could be an option to put the bond back to the issuer or vice versa for them to buy it back. So you could have buy-sell puts or buy-sell options engraved or embedded inside the bond itself. So you introduce another piece called convexity, which picks up the optionality that's embedded inside the bond. So also having an impact on how you might determine the maturity profile and what the limits are associated with the bonds. And so I talked about earlier yield curves in the market, and a normal yield curve is one that is, and you think about today, let's just say 30-day Treasury bills to 30-year Treasury bonds, and you look at that yield curve. A normal curve is from low maturity to long maturity is upward sloping. So from the left up to the right, it is upward sloping. That's a normal yield curve. We had that a year ago. June last year, we had a normal yield curve. The yield curve today is inverted, And what I mean by inverted is that the short-term rates are higher than the long-term rates. And so the way treasurers invest in duration and maturity profiles for their cash investments matters. So, you want to make sure you take the shape of the yield curve into consideration, because the market's pricing in what they think is going to happen with rates over time. And so it's natural for the yield curve to move around and change over a period of time. So these are things you got to think about. The other things are credit quality. You can take on more risk by investing in fixed income instruments that have a lower credit rating. Taking on that risk, you need to understand what that means. How much are you able to take on? Your investment guidelines should stipulate the amount that you would allocate at any one point in time to these higher yield assets. Things that would be below investment grade in particular, you got to keep an eye on. And there are, reasons why you would want to make investments in high yield bonds, especially if you're targeting industry or particular companies where you think there's a lot of upside potential for a ratings upgrade. If there's a ratings upgrade, that's actually a very good thing for your return on that particular bond or pool of bonds that you have. So, ratings you got to take into consideration and what that means. So that translates into, what risk appetite do you have? Your investment guidelines should outline that. And so when you think about investments that have traditionally been done for Treasury on the cash side of things, tends to be a lot more risk averse type investments. You want to get yield on your cash, but you want to protect that principal. One of the things you mentioned earlier. You tend to see them make lots of investments in Treasury funds, treasuries, Treasury bills, government funds. When I say funds, I'm talking about money market mutual funds. These funds, the Treasury and government funds, are, and we'll talk about this here in a second, 2A7 funds. That's a SEC rule that guides the structure of those funds, what they can do and what they can't do. And so those are the money market mutual funds, Treasury, Govy funds. Now, they do make investments in prime funds. Prime funds are a little bit different than the 2A7 funds that have a fixed NAV or net asset value. Does it fluctuate? Stays at 1. Prime funds, NAV fluctuates. So you got to understand the risk that you're taking on. When the pandemic hit, worked for an insurance company, managed to head up the treasury function there, managed to pool cash. We made a transition from prime funds into Govy treasury funds, just because the risk associated with the movement in NAV, plus the yields on prime funds were collapsing quickly towards, surprisingly, really close to Treasury and Govy funds, just because the risk appetite out there was dropping to very little to none, and the prime funds were bleeding liquidity daily. It was going out the door into these other asset classes. So we do have some regulatory changes that are coming up. Some of the things are around daily liquidity requirements, liquidity being really important to a treasurer. Going back to those 3 buckets, those pools, daily operations, working capital, having liquidity to meet needs is super important. You need to be able to tap that cash whenever you can. So liquidity is really important. Having greater liquidity is a benefit to treasurers being able to manage liquidity. Think about fees associated with these funds. What the transparency is associated with it is really important. Yeah, the NAV, making sure that there's transparency to NAV. It used to be a time where the NAV on these funds were not being struck daily. They were being struck maybe weekly, monthly, a longer period of time. Typically, I think it was monthly, going back several years for that. But that put a lot of risk on portfolio management when it came to managing cash. So you need to be aware of what these regulatory changes are and what the impacts might be, positive and negative, to you as a treasurer when you're managing your cash. So I think this article just really did a nice job of laying out these particular items that treasurers should have in mind and keep in mind when they're managing their cash across the various pools. I mean, we could probably spend an hour, at least I could spend an hour easily talking about this topic. I have so many more things going through my head, but I think I'll just stop there.
No, Paul, thank you for summarizing the key cash segmentation changes and for advocating treasurers to review the proposed money market fund reform measures. That was a really insightful summary. Let's move on to our next topic, which is about global debt hitting a record US $315 trillion. The world has amassed a total debt load of US $315 trillion, according to a report from the Institute of International Finance, or IIF, the Washington, D.C. based global association of the finance industry. This figure reflects the biggest, fastest, and most wide ranging rise in debt since the Second World War, coinciding with the COVID 19 pandemic. This increase marks the second consecutive quarterly rise and was primarily driven by emerging markets where debt surged to an unprecedented high of over US $105 trillion. That is US $55 trillion more than a decade ago, the IIF said in its latest quarterly Global Debt Monitor report. Around two-thirds of the US $315 trillion owed originates from mature economies, with Japan and the US contributing the most to that debt pile. However, the debt to GDP ratio for mature economies, regarded as a good indicator of a country's ability to service its debts, has been falling in general. On the other hand, emerging markets held $105 trillion in debt, but their debt to GDP ratio hit a new high of 257%, pushing the overall ratio up for the first time in 3 years. China, India, and Mexico were the biggest contributors, the report found. Paul, what, according to you, are the factors that can pose a significant risk to global debt dynamics, and should corporate treasury be concerned about rising business debt?
Yeah, I think there's a couple points to be made with this article. So it does a nice job of pointing out some of the challenges that we're seeing on a global basis. And obviously, 315 trillion, that's a huge number. US, 105 trillion. Both the US and Japan being the leaders in terms of quantity of that 315 trillion. The good thing is, from a perspective of looking at the debt to GDP, and ability to service debt, we're still there. Obviously, not something that's super comfortable for Americans to think about how large just the government position is. But when I think about consumers themselves inside the US, that's when I have concerns with growth in the amount of debt, because there's a portion of this attributed to not government and just businesses. We're talking about everyday working people. We've seen a run up of debt. We're in a tough environment with inflation and interest rates right now. We are looking for signs of point when we can expect the Fed might take action. I don't think we've had enough with this Fed. I think they need a longer track record. Opens up exposure to policy changes that are ineffective, meaning they make decisions too late because they're looking at historical data and trying to think about how things will trend going forward. Is always a challenge. But we are starting to see some trends in the economy that will help facilitate decisions for interest rates within the U.S. itself. So Japan and the U.S. are with trends moving down in general. That's a positive thing to see. However, you still have to manage what that load looks like from a totality. Pre-pandemic, interest rates were super low. Generating debt was an easy thing to do because it was so low cost relative to what normal kind of periods are. Now we're in a higher rate interest environment. It's makes it more challenging to service debt from a perspective of how you might distribute funds relative to wants, needs, and we're talking both from government position, funding programs, meeting needs of citizens, infrastructure, to businesses that are trying to grow and expand, and consumers that are looking to live lives at a level or in a way that they desire or need to. Then you look at emerging economies, and this really isn't super surprising from my perspective that their ratio is pretty high. When we think about China, India, Mexico, those levels are high. They're economies that are growing. And so in that growth phase, you're going to see them take on debt, and these numbers are going to look poor. relative to more advanced economies like the US and Japan. So that's really not surprising to see those kinds of numbers. When we think about the dynamics across the globe itself, it's going to be telling over the next, I think, 12 to 24 months what happens from central bank policy. And I'm talking not just the US, but on a global basis. I think they're all trying to find ways to navigate and manage through a lot of the challenges that were initially bred and kind of bubbled up since the pandemic hit. And it's created a lot of challenges globally. So where we land in terms of debt over time, I think we might see a little bit of oscillation where we could see some up and down for a period of time. My expectations are that we should see at some point that we're kind of peaking and then maybe back to maybe more of a more normal growth or pattern in terms of the use of debt, leveraging access to capital and cash to fund wants and needs.
That's a fascinating perspective, Paul. Next up, let's delve into the third story, which is about Swift and banks in AI pilots to tackle cross border payments fraud. Swift has announced two AI based experiments in collaboration with its member banks to explore how the technology could help combat cross border payments fraud and save the industry billions in fraud related costs. In the first pilot, Swift is enhancing its existing payment control service, which helps financial institutions detect anomalies that could be indicative of fraud. By using an AI model that will create a more nuanced and accurate picture of potential fraud activity using historical patterns of activity on the Swift network. In a separate experiment, Swift has convened 10 financial institutions to test how it can cause advanced AI technology to analyze anonymously shared data from different sources in a way that will strengthen the global financial ecosystem. Paul, do you think Swift and global banks teaming up to combat cross border payment fraud with AI is a significant step towards a faster, more secure, and ultimately more efficient cross border payment ecosystem?
I think it's definitely a step in the right direction. What I see out there today, and I'm just going to focus on payment fraud purely, is that the fraudsters out there, they are becoming more savvy. And they're always looking for ways to steal money. The reason why is that they become very successful at doing it. Whether it's businesses or individuals, they have found ways that work and they'll keep working those ways over and over and over again until they can't anymore. At the same time, what they're doing is they're becoming very tech savvy. And so they're designing new ways to steal money from organizations. So from a treasury perspective, as treasurer, payment security should be top of mind all the time. And we should be educating our treasury team on a consistent basis and testing their knowledge because this is changing rapidly, especially with the introduction of AI. We had earlier this year a big deep fake. I know you put an article out on it. $25.5 million went out the door with a Zoom call that went to a treasury director that assumed he was talking to his CEO and other executives. 15 banks he delivered money to. They really felt like this was legit and it was totally fake and bogus. And that's really scary when you think about that. They got tricked with artificial intelligence and looked like the people, mannerisms, the way they spoke, their sound wasn't 100%, but it was enough to fake them out and cause somebody to send out $25.5 million. That's a big deal. That just tells you right there. Fraudsters are becoming more sophisticated. And guess what? That group is going to get better at what they did. They're going to try again. And I won't be surprised if they have more success doing that. I think we talking payment rails like Swift, Fed, other payment rails that are out there, treasurers, banks, vendors, all of us need to get up to speed, be up to speed on a regular basis and actually be ahead of the fraudsters. We need to be thinking not only about what's happening, but what could happen down the road so that we can prevent capital and cash being stolen from organizations. So I think what Swift is doing here is a great step forward. I think there's definitely more to do and collaborate and making it open to organizations so all can participate in this. I think this is super important, super critical as a treasurer. This should be top priority.
Well, Paul, you made some great points. I couldn't agree with you more that we all need to work together. We all need to collaborate. All the stakeholders need to come together. And to your point, when you mentioned deep fake, I, for one, think that deep fake will perhaps emerge as the foremost payment security threat for corporate treasurers and CFOs in 2024. So thank you for that informative insight. Let's move on to the fourth story, which is about digital wallets in the US getting a business bump. According to a recent survey by Federal Reserve Financial Services, or FRFS, US businesses are rapidly adopting digital, faster, and instant payment services to improve customer experiences and engagement and their own efficiency. In 2023, the use of digital wallets, many leveraging embedded payment platforms, grew 31% year over year to 62%. This was driven by large businesses and the service industry. The survey also highlighted how digital wallet platforms and instant payments are changing the way businesses conduct commerce. Most businesses, that is 74%, would prefer that faster payment services be provided by their primary financial institution rather than a secondary financial institution or non-bank payment service provider. Paul, do you think instant payments will boost the use of digital wallets by businesses and make it their preferred payment method in the near future?
I could definitely see a trend that direction. We think about how things have moved over time with the use of people's phones or smartwatches or other ways to make payments with businesses. It's become so much easier to do these things. I think businesses will welcome, of course, there's always costs associated with doing these different things. So when it comes to this, as a business, one, it's obviously security of payments and how that works, costs associated with delivering instant or real-time payments, and the ability to have the right infrastructure to accommodate that. I think organizations that, especially on the retail side, that deliver products and services to consumers, I think will gobble up the ability to get payments instantly at a greater rate over time. I think the survey demonstrates that companies are looking to have a greater turnover in terms of when cash hits the books. And I think they realize, hey, it's better get that dollar today versus get the dollar tomorrow or 3 days from now in the form of check writing, which takes time, right? So I think this is just indicative of what the future looks like. Digital wallets are more and more common. I have a digital wallet. I use it, and it's really easy to use, and it works. So I think, just the fact that consumers like myself and others are adopting it at a higher rate, it's actually forcing business to really step back and look at it and say, well, what should we be doing differently? And the survey shows that, especially at the end. I like how at the end we talk about the immediacy of account posting or access to funds or notification of when it's available, all in the 80% range. And when you think about costs or customer or flexibility to pay or customer preference or the 24/7 instant payment services, 35 to under 50%. So those first three are the ones that businesses are looking at, even though I think the customer adoption rate or the preference to utilize these tools are really important. I think organizations are looking at it just a little bit different than the consumer itself. And so I think they actually come together, even though these percentages look different, I think they actually come together and you're getting alignment between business and consumer.
Yeah, Paul, thank you for that valuable piece of analysis and viewpoint. Finally, what is your choice for the biggest or most important story of the past week and why?
Yeah, so I think I got two that I would like to highlight. And the reason why is first one I'll pull out is pretty obvious, and it's around the verdict on former President Donald Trump. I think this is a big deal. And I'm not sure that politically people who are on one side or the other, I think that perhaps the outcome of this, it may play out a little differently in what some political advocates may perceive. I could be wrong. I'm not political junkie, so I don't know what they actually think. But from my perspective, I think it's a big deal, especially when you think about how much cash he raised in 24 hours after the verdict came out. That was like crazy. I didn't expect that at all.
$35 million, perhaps, or more.
Yeah, it was insane, right? This election, I think, was going to be pretty interesting for sure. I thought that was a big deal. Now, at the end of the day, what do I think's going to happen? I'm not a lawyer, but when I think about that, he's going to appeal, and he's going to appeal, all the way up to the highest court he possibly can. Do I think the verdict stays? I have no idea, but I'm kind of on the side that, he's going to fight it all the way, and if he gets it to the Supreme Court, I'm guessing there'll be something that will overturn what happened. I just have this gut feeling. I could be wrong. I don't know. Whether you believe he did or didn't do it really doesn't matter. The whole thing was just kind of crazy and bizarre how it all played out. But the other piece that I'm looking at is around some of the economic indicators that came out in the last week. We're starting to see signs that the Fed interest rate hikes are working. We are seeing that there are less jobs available out in the market. So when I think about from an economic standpoint and what I think the Fed's going to do, the Fed is going to be looking for a trend. And the question is how much trend do they really need with economic indicators to say, okay, inflation is taming, level of jobs is coming down, wage growth is subsiding. When do I decide to go ahead and cut interest rates? This is something that we as treasurers have to keep an eye on. You need to anticipate what you think might happen over a period of time. The timing of it, I think, is something completely different. But if you're a treasurer and you're thinking about, hey, capital funding, for instance, I want to raise capital, how do I want to structure this particular instrument that I want to issue to raise capital? Do I want something that's fixed? Probably not. Might be more a little focused on something that's a floating rate. And you can kind of pick what you think the duration of that particular instrument might look like. But, I think these are things that, from a treasurer's perspective, keeping an eye on what the Fed's going to do and these economic indicators is going to be really important. So looking at jobs, wage growth, definitely want to keep an eye on what's going on with the consumer, and not just the spending in particular, but the level of debt that consumers are taking on. And one of the things that I've just had in the back of my mind, this last season with Christmas, a lot of U.S. consumers were doing the buy now, pay later, which is, they're financing the purchase of gifts and other items. That's picked up, not just for that, but just for other things that consumers might purchase, couches, chairs, appliances. We've seen, an uptick in those areas, the level of debt that the consumer has, and when we see wage growth subside and we see that jobs are coming down, we could be in for perhaps, I don't know if we're going to have a soft landing. I know that's been the word that's thrown out there quite a bit. We could potentially, depending on what the Fed does and their actions, we potentially could have, a recession in our future still. I don't take that off the books. I think there's still a percentage that could happen, but Fed action is going to dictate based on where the economic indicators are. If we have another uptick in jobs and inflation, then, that's going to be really problematic. I don't want to be in a position where stagflation becomes the norm. That's an uncomfortable environment to be in and challenging from a Treasury perspective.
Well, that brings us to the conclusion of this episode. Many thanks to you, Paul, for joining us and enriching today's episode with your insightful analysis and expertise in treasury management. We also want to express our sincere appreciation to our CTM File audience for tuning into this edition of the Open Treasury podcast. Please subscribe to our podcast and check out the show notes for links to the articles discussed. Thank you and have a wonderful week. This podcast is provided for information purposes only, and statements made by CTM File or guests on this podcast are not intended as legal, business, or consulting advice. For more information, visit ctmfile.com.